You're watching Advisor Talk with Frank LaRosa. It's the only podcast offering unfiltered guidance and direct advice for anyone in the financial services and wealth management industry. Learn more today at eliteconsultingpartners.com/podcast. And now, here's your host, Frank LaRosa.
Hey everybody, welcome to Advisor Talk with Frank LaRosa. I am your host, Frank LaRosa. I am in my car. For those of you that are not watching on video, I got a little bit of a drive, so I figured I'd give you all what's on my mind while I'm driving, be as efficient as I possibly can. The reason for this podcast this week in this video is really because there's been a couple things that have come up over the last couple of weeks that I haven't been on top of in terms of communicating to everybody, to my audience. So I hope you enjoy it. And obviously, leave a message, DM me if you'd like. Obviously, subscribe to my podcast. Email me if you have any questions or comments at frank@eliteconsultingpartners.com. But anyway, the first thing I want to talk about is what's going on at Merrill. There's been a lot of movement at Merrill, a lot of large teams moving. It doesn't really matter what the firm is that they're going to or who the firm is. The fact of the matter is, large teams are moving and are going to continue to move. This includes some of the private banking world. I think we're going to see some movement there to firms like UBS. They've been picking up a lot of those teams. But Andy Sieg was interviewed in an article a couple weeks ago, and I just thought it was really interesting because some of the things that he was saying were really contradictory to what I see going on, and that is he didn't see a big problem with attrition, which I don't know how that's possible when he sees the number of large former what I call lifer Merrill producers, meaning these were large teams that made their careers, set their careers at Merrill Lynch, and they would never consider making a move in the past. And now all of a sudden, these veterans, these high quality, seasoned veterans are leaving the firm. And what I'm hearing from some of these advisors is that Merrill left us a long time ago. And it is, whether you believe that or not, advisors are voting with their feet. So you can have your opinions or you can't have your opinions, but the truth of the matter is these teams are leaving every week. Whether it's a Rockefeller move or a UBS move or Morgan Stanley's hiring this team or whatever it is, LPL's hiring big teams. What I see happening at Merrill Lynch, this is my opinion, it's not a fact, so I'm just stating my opinion from 25 years of experience. I see them slowly moving towards this salary bonus private banking model where the advisor, there's a main advisor at the top, then there's a team underneath them. Let's call that the Bernstein model, where the main guy is the one making all the money, woman, and then the people underneath are essentially bonus salaried W-2 employees, and they spread out the relationship across all of those teams so that it makes it very difficult for the advisors to leave, which is why you don't see a ton of advisors leaving Bernstein, because it's hard to do. The other thing I see, or that he talked about, is the fact that they're enhancing their training program and they're working on creating synergies between financial advisors and the banks. All that really means is we're locking in our financial advisors, because once they start working and spending all of their time developing banking clients, those banking clients can't leave the firm if the advisor leaves. So if you're an advisor that spends 10 years developing a book of business with the local Bank of America office, you've just worked you got paid, but you've built no value in your own business, because if you were to leave, you can't take those clients with you. That's their whole model. and they're slowly. I'll say slowly. I don't really even know if they're trying to mask it anymore. Somebody just almost ran me off the road there for a second. That would have been interesting to have on a podcast. They're not really even masking the direction that they're going in terms of, I'll call it glorified bank tellers. In my opinion, not that there's anything wrong with bank tellers. My wife was a bank teller when I met her at Fidelity, First Fidelity, whatever it was called at the time. It was a long time ago. Anyway, that's the direction they're going. I think within the next 12 months, you're going to see the Merrill, because it's no longer Merrill Lynch. Right now, it's Bank of America Merrill. I think within the next 12 months, you're going to see the Merrill go away. I'm not sure what they're going to do with the bull. I'm not sure if they're put him out to pasture, or they just put a bull in his head. I'm not sure. Sorry to be so graphic, but that's my opinion. I just think it's sad to see what's happening with a firm that was really the preeminent firm in the wealth management space. So I think that's what's going to happen. And I think that if you're at that firm and you're not seeing it, maybe you have a great branch manager that's keeping you protected from all that noise. But just look at the news rags, look at the advisors that are leaving all the time. Some of these advisors, a lot of them, are going to independent platforms where they're not really getting a lot of money to move. As a matter of fact, one would argue that it's almost a break even because these advisors have a lot of deferred comp that they're leaving on the table, and it's gotten so bad that they're leaving the deferred comp back and they're taking a lot less money. So look, that's not what I see. It is what it is. I call balls and strikes. I don't care what pinstripes are on the uniform. The other thing that I want to talk about, I don't mean to rant about it, but it's been on my chest, and I wanted to get off my chest for a while now, because I read this article and I was so frustrated, and I was like, I don't know if he doesn't care about what's happening, or he's oblivious to what's happening. And I'm not really sure which one is worse. That's for you all to decide as listeners. The other thing that I did, which was very interesting, and I'm not sure really why it's never come up in the past, but I was doing a pro forma for a client over the weekend. We're going to shift gears. We'll move away from firms, and we're going to talk about money. I was in the office on Saturday for a few hours, and I was running a pro forma for a client. They're at a wirehouse firm, and they're considering two options. One is going to another wirehouse and just taking the check. I have my other hand on the wheel, by the way. And then the other option is taking less money and going independent. And if you take the transition money out, or even with the transition money, right? I've said this over and over again, I'll say it again. The break even is really only about, I'll round it up and be conservative and say 4 years, that even getting 150, 160% check up front, your break even, total break even for going independent, for going independent is about 4 years. You're ahead of the game going independent, and you are significantly ahead of the game after 10 years, after taxes. But in the same week, last week, I had two clients say to me, Frank, that might be the case, but if I get $3.5 million from Morgan Stanley, as an example, I can invest that $3.5 million, and even if I grow it at 5%, I can almost double it in 10 years, right? Rule 72, so 5% is not quite a double. I said, okay, fine. Let me bake that into my spreadsheet. I would argue that I have probably one of the most accurate pro forma spreadsheets that you'll see. It gives a very, very close estimation of what an advisor should be generating in terms of net income, as long as they give me the right information. Garbage in, garbage out. But anyway, so I spent some time and I built that into my formula. And, I took the money. You're going to get the money. The upfront money gets essentially forgiven over a period of 10 years. So you're only paying tax on the money 1/10 every year on the forgivable piece. There's some nominal imputed interest. It's not really a lot, so it doesn't really come into play. It's like 0.39% or something like that. But what I did was I took that $3.5 million and invested it at 5%. I also took the back ends of the bonus that they would get if they went to Morgan Stanley in this case, assuming they hit year 4, 2, 3, 4, 5 numbers, which 4 and 5 numbers are meant to be stretches from firms. If you're talking to a wirehouse firm and they tell you it's not going to be a big deal for you to hit 4 and 5, that's not the firm's opinion. The firm's opinion is roughly only 10% of advisors hit year 4 and year 5 numbers. So just keep that in mind. But anyway, I made an assumption that this advisor hit all those numbers. So I baked that into the formula. And normally when you get that back-end bonus, it's taxed in the same year as ordinary income. So I baked that into the number. That gave me a number of roughly, I forget the number off the top of my head, but it was not quite a double, but it was up there. Then what I assumed on that number was a 20% long-term capital gain rate. So I assumed that they sold their positions and went to cash and paid 20% on all the number. So they started with 3.5. They got an additional, let's call it 300 after tax on the back end bonuses. So 3.8. And they essentially netted after tax roughly $3.6 million. I'm driving in the car, not going to look at the reports because someone will send me nasty grams about me reading and driving at the same time. And there's traffic. So follow me there. So I took that number. Then what I did is I went down to the independent line where they're getting 55%. So I took that number, which was roughly 1.3 million or something like that. No back-end bonuses, but their income, just the income component alone, is double, right? So in this case, it was roughly a $400,000 increase on an annual basis in income over W-2, right? So they had a delta of $400,000 to $500,000 every year because they were independent. So I made an assumption that you took that $400,000 or $500,000, which was net of income tax. So it was the remaining cash, and you put that in with the $1.3 million initial investment. So you put that into your investment account, which then grew at 5%, which then you sold at the end of 10 years, and you paid long-term capital gains rate of 20%. And that number came out to roughly 2.6 million and change. So I baked all of that in there because I'd never been asked to do that before. For some reason, I'd never been asked to do it before. It was a great project. I know that it sounds odd that I get excited about doing Excel spreadsheets, but I like to know the information. The more I know, the more I can help my clients. So that's why I put in about 4 hours on Saturday doing this thing. It was beautiful inside. Anyway, so I figured out over a 10-year period of time, this advisor was doing roughly 2.4 million, I think. They were being offered 150% plus above back ends. Their total after-tax accumulated wealth, so their income plus their investment and their return on the investment, going W-2 was roughly 10 million, a little over $10 million over the 10-year period of time. The same advisor going independent without any recruiting, meaning that they didn't bring any producers in their office to get an additional override of cash flow. That same analysis generated $14.5 million in net after-tax capital. That's like a 45% increase in capital. I thought that was amazing because I'd never done that before. It was fairly accurate with the taxes and everything. I changed the analysis to, well, what happens if the advisor gets 7%? Same scenario, but the 45% differential or delta went down to like 39%. So still a significant increase in after-tax realized capital, not capital gains, but realized capital to the advisor that went independent. That was amazing to me. And my point of telling you, everyone, this is there's two numbers that you should be thinking about when you're looking at making a move. To boil down all these spreadsheets and all this noise, all the noise that people talk about, 90% this and 87% that, and I can give you 95, and I can whatever. I'm talking about all about the net. This is like all about the cash. How much cash are you going to end up with at the end of 10 years? The two numbers that you should just focus on if you want to boil it down to its simplest number. Your increase in income on a monthly basis when you go independent is going to be roughly 40 to 50% more. Really 2x, not even 50%. That's not really accurate, because if you're netting $30,000 a month, 50% would really only be $15,000. You'd be netting 45. It's really like a 2x. So if you're netting $30,000 a month in after-tax income in a W-2 environment, a good assumption, if you're just trying to do, sort of napkin math. Sorry, there's a trunk here. Do napkin math. A good assumption is your 30,000 is going to turn into roughly 50 to 60,000, depending on where your office is and how much space you want to put out. But that's really going to be like a 2x. So a second assumption is really going to be at the end of 10 years, no matter what a wirehouse wants to show you, if you take that money and reinvest it, your total accumulated cash after 10 years is going to be, we'll round it down and say between 30 and 40% more if you go independent. That's the math. I'm sure there's an anomaly out there that where it's a little bit different. I'm not really sure what that noise is, but that's the math. It's a car. The car's making noise. If you want me to go through the math with you, I'm going to host a live event called a live Zoom by invite only. And I'm going to actually walk whoever wants to join, whoever wants to see this spreadsheet, or whoever wants to see me go through this spreadsheet. I'm going to host a live event in a few weeks. I'll let you know when it is. And I'm going to walk through what I just talked through. It's a lot to put on a grease board. Maybe I'll put on a grease board like I did once before. But I don't know, maybe I'm a geek when it comes to this stuff as a business owner. I love to know the numbers. One of the most important things you can do as a business owner is know your numbers. If you don't, you're not going to be a successful business owner. But 2x and 30 to 40% more. Those are the two numbers you need to understand when you're considering leaving your current firm and going to another W-2 option or going 1099. Anyway, that was my 25-minute rant. I hope you enjoyed it. We have some great guests coming up soon. I've been really on a tear, and one of the reasons why I haven't posted much of this stuff recently is because the activity level within the business has ramped up, and it's feverish. Deals are at an all-time high again. they pulled back for a while, but in the wirehouse space, regionals, everybody's fighting for your assets. In the independent space, everyone's fighting for your assets. Valuations are going up. We're working on a few deals where our clients are getting valuations on earnings, not revenue, on earnings that are, 8, 9, 10 times EBOC, which is earnings before owner's comp, and higher. Not to get into those details, but they're higher. There are some firms out there that are throwing around a lot of money. Throwing around a lot of money for your assets because they're being very aggressive. They want those assets right now. So if you're a financial advisor, RIA looking to make a move, if you own a broker dealer and you're tired of all the headaches and all the bullshit, you need to consider rolling up into another larger institution and just becoming a producer group for your existing advisors. I can show you through another spreadsheet how you can make more money doing that and still deliver all the service and culture that you want to your advisors. Bottom line is, there's a tremendous amount of opportunity for advisors out there where you don't have to be unhappy in your current situation. You don't have to be at a firm because you think you can't deliver the same level of services or products or scale that you want to be able to deliver with your current firm. We work with well over 100, 125 plus firms that we've represented our clients to. And there really isn't a solution yet that I haven't been able to find for a client. It's one of the exciting things about our business and how we operate, my firm, and how I operate, really peeling the onion back with a client and understanding what it is that they need. And then we go to the market and we find it. Maybe it's a firm that we're already working with, we've already brought clients to. If it's not, we go and we start knocking on doors, figuratively speaking, of course. We go and we do a search. I have a great COO, Dale Dempsey. He is awesome at finding information on different firms to help us provide a solution to our clients. If you ever want to talk to him, give him a buzz. His email is dale@eliteconsultingpartners.com. This is a shout out to Dale. And his phone number is 856-316-4653. He's a great guy. He'd be happy to help you. I'd be happy to help you. Thank you for listening. Don't forget to share this. Check out our YouTube channel, Advisor Talk with Frank LaRosa. Check out our podcast. If you're not listening to this on our podcast, like and subscribe. Hit that like button, smash that like button, leave a comment, 5-star rating, of course. And if you have friends that really need some help, share this with them. Go to our channel. There's a ton of great content that aren't commercials about other firms. It's great content that advisors should be listening to understand what's happening around them. Anyway, thanks a lot. Great talk. We'll see you next time.
Thanks for watching Advisor Talk with Frank LaRosa. If you enjoyed this video, make sure to check out some of our other episodes. Don't forget to like, share, and subscribe to our channel, and we will see you back here next week.